Let me give you two numbers, 8% per year and 15% per year. Both are structure notes, same tenure, same level of capital protection, both issued by large reputable banks. And yet, one pays 8% and the other pays 15%. Most investors, when they see that, ask one thing, how do I get the 15%? But that is the wrong starting point. The better question is, what is the 15% actually telling me? Because every price is information, and in a structure note, the coupon is information. It tells you what risk the investor is being asked to accept. So in this video, I want to show you how to read that number properly. There is one idea I want to establish first. It sits underneath everything else in this video. A structure note coupon is not generosity. The bank is not offering you 15% per year because it likes you or because it is having a good day. Every coupon is compensation. What I mean to say is the bank is paying you for something. It is paying you for the risk you agree to take within the structure. When I was at the Swiss bank in Geneva, clients would ask why one paid more than another. And the answer was usually quite simple, because one of them was asking the investor to accept more risk than the other. That is the whole foundation. Now, what kind of risk? That depends on a few things. It depends on the market environment, it depends on the choices built into the note, and it depends on who is issuing it. So in this video, we are going to rip apart that coupon and understand what is actually sitting inside it. The first factor is the interest rate environment, and this one is foundational because it sets the base for everything else. If you've watched video 2, you know that when you rip apart any capital protected structure note, there are essentially two components, a bond and a derivative. The bond portion is there to help protect your capital at maturity. The derivative portion is what creates the potential return. Now, here is the key. The bond portion has a cost, and that cost moves with interest rates. When interest rates are higher, less capital may be needed to create that maturity protection, which means more can be available for the derivative. More budget for the derivative means more room to engineer a higher coupon. When interest rates are low, the opposite happens. The bond portion becomes more expensive to put in place. Less capital is left for the derivative, and naturally, the coupon potentially comes down. Now, this is one reason why structure notes built in 2024 looked very different from notes built in 2019. The interest rate environment has changed significantly, and that change flowed directly into what was available to investors. Now, interest rates do not tell the whole story, but they set the base. Everything else is built on top of that. Now, let us talk about volatility. And in my view, this is the factor that most investors overlook. Volatility, simply put, is how much an asset moves. A stock that goes up 20% one year and down 15% the next, that is a volatile asset. An index made up of 500 companies, it moves too, but more slowly, more predictably. Here is why this matters for structure notes. The derivative component, the part that generates the return, is built using options, and options are priced based on volatility. When volatility is high, those options are more valuable, which means the bank can use the same derivative budget to offer more. Higher coupons, better returns, more attractive structures overall. When volatility is low, the opposite is true. Options become less valuable, the derivative budget does not stretch as far and the coupon potential comes down with it. But, and this is important, a higher coupon in a volatile market is not a bonus. When an asset is volatile, it can also move sharply against the investor. A barrier that seemed conservative when the note was structured can be breached faster. That risk is real. So when a bank offers a higher coupon on a volatile underlying, it is compensating the investor for that uncertainty. The coupon is higher because the risk is higher, not because the bank is being generous. That is the pattern across every factor we'll cover today. Higher returns, higher risk somewhere in the structure. The coupon is always telling you something. We have talked about volatility as a concept, but volatility does not exist in the abstract. abstract. It comes from the underlying asset, what the note is actually linked to, and the choice of underlying is one of the most important decisions in the entire structure. Let me give you a simple example. A note linked to the S&P 500 index, that index is made up of 500 large companies across many industries. No single company controls the outcome. If one company has a bad year, the other 499 absorbs it. The index moves, but it moves within a relatively predictable range over a time. Now take a note linked to a single stock. For argument's sake, let's say a large bank or a major technology company. That is one company, one management team, one set of quarterly results, one regulatory decisions can move it 20% in a single day. The concentration is much higher and so is the volatility. And we discussed in the last section, more volatility in the underlying flows directly into the coupon. The bank can typically offer more, but the investor is also more exposed. If that stock falls 50%, the note absorbs that fall directly. There is nothing else underneath it. This is why the underlying is not just a name on a term sheet, it is a risk description. When you see a note paying a very high coupon, one of the first things you look at is what it is linked to, because that will tell you a great deal about why the return is whatever it is. Now let us talk about the barrier, and a second factor that many investors overlook entirely. The barrier level is a form of protection. The lower it is set, the more room the underlying has to fall before the investor's capital is at risk. A barrier at 60% means the underlying would need to fall 40% before capital is exposed. That is meaningful buffer, but that buffer has a price. It shows up in the coupon. A lower barrier, more protection, typically means a lower coupon. A higher barrier, less protection, means the bank can offer more. As always, the trade-off is built into the pricing. Now, there is a second dimension that many investors miss. Not just where the barrier is set, but how it is monitored. In some notes, the barrier is only checked at maturity. The underlying can dip below the life of the note, recover, and the investor is still protected. That is a European-styled observation. It is less restrictive, and that is reflected in the pricing. In other notes, the barrier is checked continuously. If it is breached at any point, protection is lost. The investor accepts more risk and the coupon can be higher as a result. We will go deeper into this in a later video, but the point for now is simple. Both the level of the barrier and how it is observed affect the coupon, and both are part of what the investor is agreeing to when they look at that return. Now let us talk about tenure, the length of the note, and this one has more to it than it first appears. The common assumption is that a longer tenure always pays more, and for many notes, particularly those linked to indices, that holds true. The investor is locking up capital for a longer period. The bank compensates for that. The longer you commit, the more you are typically paid. But there is another dynamic, and it shows up most clearly in notes linked to individual stocks. For many volatile stocks, the near-term uncertainty is actually higher than the long-term uncertainty. A stock facing an earnings release, a regulatory decision, a major product launch, the short-dated implied volatility around these events can be very elevated, which means a one-year note linked to that stock might offer a higher coupon than a 3-year note on the same underlying. The shorter tenure is capturing a period of concentrated uncertainty, and the bank prices accordingly. So the relationship between tenure and coupon does not always run in one direction. It depends on the underlying and on the market environment at the time the note is structured. What is always true is that the coupon reflects what the investor is agreeing to accept, whether that is a long lockup, elevated near-term volatility, or both. The return tells you something. There is always a reason, there is always a trade-off. The last factor is the issuer, the bank that creates and stands behind the structured note. And this connects directly to what we covered in video 4. A structured note is not only linked to an asset like the S&P 500, Tesla, Apple, or a basket of shares, it is also a promise from the issuing bank. That bank is saying, if the conditions of the notes are met, we will pay you the coupon, and at maturity, we'll return your principal according to the terms of the note. So the strength of the issuer matters. Now, here is the simple way to think about it. A very strong bank can usually borrow money at a lower cost because the market sees it at a safer. A weaker issuer may have to pay more because investors are taking more risk by lending to it. That difference can show up in the structured note coupon. So sometimes two notes may look very similar on the surface, same underlying, similar barriers, similar tenure, but one pays a higher coupon because the issuer itself carries more credit risk. That higher coupon is not free. It is compensation for taking more counterparty risk. In other words, you are not only taking what is this note linked to, you're also asking who is standing behind the promise. Some investors may prefer only the strongest issuers and accept a lower coupon. Others may be comfortable taking more issuer risk for a higher return. Neither approach is automatically right or wrong, but you must know what you are being paid for, because the coupon is not only telling you something about the underlying, it is also telling you something about the issuer. Now let me bring everything together with one example. For argument's sake, two notes, both 3-year, both with 60% barrier, both issued by the same bank. The first is linked to the S&P 500, it pays 8% per year. The second is linked to Tesla, it pays 16% per year. Same structure, same tenure, same barrier, same issuer, and yet double the return. Why? It is not so because the bank is being more generous with the Tesla note. It is because the underlying is fundamentally different. The S&P 500 is an index of 500 companies. No single company drives the outcome. A broad index behaves very differently from a single stock because it is diversified across many companies. Tesla is one company. Its share price can move 20%, 30% in a matter of days. The implied volatility is much higher, and as we discussed, higher volatility in the underlyings means more can be offered through the derivative component. And here is the key point. Both notes have the same 60% barrier. Both underlyings would need to fall more than 40% for the investor's capital to be at risk. But the probability of that happening is very different. Tesla can fall sharply and quickly in a way that a diversified index of 500 companies simply cannot. The same barrier carries a different level of risk depending on what is underneath it. The 16% is not a better deal than the 8%, it is a different deal. And the difference, every percentage point to it, is the market pricing risk. That is what this video has been all about. So the next time someone shows you a structure note, before you judge the coupon, ask what is underneath it, what is the underlying and how volatile it is, where is the barrier set and how it is observed, how long is the tenure and who is the issuer. Every one of those factors shapes the return, and every one of them is telling you something about the risk you are agreeing to accept. That is the shift I want you to take away from this video. Do not start with the coupon, start with the risk behind it. In the next video, we'll look at who structured notes actually make sense for and who they do not. Because this is not a product that fits every investor, and knowing where you stand is just as important as knowing how the returns are built. I will see you in the next one.